Hello everyone, welcome to Betty Academy, where we make school easier. So please support this channel, subscribe, watch, like, share, comment down below, hit on the notification bell. And in this lesson we are going to learn about the dividend relevance theories, and the first one to start with, I'll start with the band in hand theory of dividends. So I have an illustration that will help in the I'll be explaining on what is in this particular illustration. So a band in hand theory, this one is a theory on dividends. So it's a byproduct of the irrelevance argument. Is that stockholders are indifferent between dividends today and capital gains tomorrow. That is, investors use the same discount rate in putting a present value on these two streams of cash flow, even though these different streams are characterized by different risk levels. The bird in the hand theory of dividends takes a fundamentally different view of things. In particular, this theory holds that investors are not indifferent between dividends today and an equivalent amount of capital gains in the future. Rather, they prefer a more certain dividend today to a more uncertain capital gain tomorrow. So, in this particular theory, so what happens is the moment you invest, once you invest, in this case, maybe you've bought some shares, so automatically you become a shareholder. And the intention of investing is that by the end of the day, you expect you'll get dividends, or rather, if after a certain particular time, you may sell all your shares and get the capital gains. So in this particular theory, what happens is it's the band in hand theory of dividends. So, and that's why from the explanation that I had just done, it says that the stockholders prefer a more certain dividend today to a more uncertain capital gain tomorrow. So what the band in hand theory says is that investors discount the expected capital gain yield at a higher rate than the dividend yield. Yeah, so the moment if you are expecting that you'll get a certain amount after 5 years, so to get the current present value of those whatever the cash flow that you'll be expecting to get in form of a capital gain, is that there has to be that particular discount rate that they use so that you can get the present value of money. So this one you can also get it from the concept of time value of money, and apparently that rate is higher than the dividend yield, right? So thus firms that engage in a high dividend payout, in that the moment firms engage in a high dividend payout, it means that they have a low expected capital gain yield, right? Yeah, because if you really pay out a very high dividend yield, a high dividend payout, it means that you'll have a low expected capital gain yield. So we have stockholders who prefer high current payout, a lower total rate of return than firms that follow a low dividend payout. So a lower required rate return results in a higher stock price for firms that match the high current payout pattern desired by bird in hand investors. So we can refer this idea by looking at what we have in this particular illustration, where we are able to trace out that the dividends today versus capital gains tomorrow. So this one is a trade-off, and we'll have the bird in the hand investors. They will pay more for the stock of a firm that was positioned at point B. When you look at point B, we have a high dividend payout. This one, we have this particular graph, and it is the trade-off between dividends and capital growth in future. So this particular arrow, you have the total dividends, right? And on this other side, the total dividends. So in this particular case, it means at this point A, we have a low dividend payout. meaning that most of the profit that we have, it is retained, and once it is retained for future reinvestment. And so the expectation is that there will be a high growth in future, so the growth will be high. And on this other side, we have high dividend payout. So the moment you distribute all the profit, it means that you'll be left with very low profit, or very low profit. And so it means that you'll not have much to invest, meaning that you'll have the low growth in future. But here we have, it's an aspect of 50-50, meaning that partly 50% you pay it in form of dividend payout, so you'll have moderate future growth. So that is what it's being shown in the illustration. So it means that at point B, they would for an identical firm that was positioned at point A. Why? Because its cash flow stream is more certain. So that's what explains about the bird in hand theory. So basically that one, it's evident that the bird in hand theory, it is also known as the bird in hand dividend theory, or dividend relevance theory. So it also shows that, from research, it shows that over the long run, dividends make up about 40% of total stock market returns. So this makes a strong case regarding dividend relevance for investors, and that is what bird in hand theory is all about. So dividend relevance, so it's something every good dividend investor should know a little bit about. So this one, it's just from we have the bird in hand. It's this one, it's just a belief that investors place a high preference for the receipt of dividends, and it is sometimes referred to as a dividend relevance theory. So when you hear of the bird in hand theory, just have it. It's just from the old saying, where it's based on an old adage. It is a bird in the hand is worth two in the bush. So the saying means that it is better to hold on to something you have now or can count on receiving soon, versus the risk of losing whatever it is by trying to get something bigger and better down the road. Because you're not sure of the future, and that's why we have this particular illustration. So that's what it shows. We have the bird in hand theory of dividends. That's why you just remember that one is just something to help you remember. It's from that saying, where we have one bird, the bird that you have in hand, it's worth two in the bush. And that's why this particular kind of investors, they prefer high dividend payout at all costs. So that's the end of this lesson. Until next time, kindly watch out for our next video. Don't forget to subscribe. Until next time, goodbye.